This is about international stock funds, and do you actually need them? This is a hot topic. So the person goes on to say or ask, in general, what is the proper allocation as a percent of your total equity portfolio during early retirement for someone with a moderate risk tolerance? Given the strong US dollar, the long stretch since international equities have outperformed US equities, along with the relatively high correlation between the developed international market index and the US total stock index, market index, does it still make sense to hold international stocks? They have been a significant drag on portfolio performance. Man, that's a good one. I generally try to stay away from talking about any sort of investing or allocations or, God forbid, specific security discussions because this is not investment advice. Anyone listening, I am not giving you recommendations or guidance or specific what you should or shouldn't do with your investments. This is all just helpful hints, educations, and stuff to think about when considering what may or may not make sense for you. But I figured I need to sort of address this one. So international stocks are just simply stocks of companies that aren't US-based companies. So like BMW is based in, is it Austria, I think, or Germany, or whatever. One of those Germanish, I think it's Austria. I don't know, German. That's non-US is the point. Nestle, the big chocolate maker is based in Switzerland. That's non-US. So that's an international stock. Honda, Toyota, those are based in Japan. Those are international stocks. Now they may have shares that trade on the US market, but they are international companies. Their stocks are international stocks. So there's a school of thought that there's a few thoughts here, but if you hold U.S. companies, especially the large multinational companies that have operations and sources of revenue throughout the globe, don't you already have enough international exposure? Like using Apple as an example. And again, this is not a recommendation to buy or not buy Apple or sell Apple. It's not. I'm just using it as an example because we all heard of Apple. Apple's US based, right? But a large part of their business, they sell iPhones and computers, all and whatever other services, I don't even know, all over the world, Europe, Japan, South America. So Apple's a huge multinational company, and no doubt, a non-trivial portion of their business comes from international markets, from non-US markets, buying their phones and their products. But is that truly international exposure? It's not, in my opinion. Now, other folks, and I know lots of you listening, are really good, really well-educated DIYers. You follow the likes of J.L. Collins, Simple Path to Wealth, which I love. Great book, great person. And he speaks a lot of really good, really accurate, valid stuff, in my opinion. His view, for example, is that no, you don't need to actually invest in international stocks. Simply investing in the total U.S. stock market is enough indirect exposure to international risks and macroeconomic things, such as the case of like Apple, who has a decent sized business from abroad. I don't take that same view. It's hard to sort of explain and put this rationally in words, but yes, I fully acknowledge there's some indirect international exposure by holding U.S. multinational companies like Apple, like Microsoft, like whoever else is big and global and does operations throughout the world. But it's not truly international. So it doesn't quite capture as much impact of like the bigger macroeconomic variables that could be impacting different countries, like labor markets, for example. The labor markets or just overall economic health or the level of interest rates in certain countries, those things aren't teased out as cleanly or directly by having exposure to their consumers buying Apple iPhones. It's not teased out as much as being truly a Japanese company, for better or worse, who's subject to demographic trends in Japan, interest rate trends in Japan, currency fluctuations of the Japanese yen versus the dollar versus the euro versus other major currencies throughout the globe. Things like that. So in my view, international stocks are international stocks. You shouldn't really just bastardize it. And I don't mean that in a bad way, but like just look at US stocks and say that's good enough. Now, here's the rub. Historically speaking, U.S. stocks have done much better than international stocks, and I fully acknowledge that, especially since the global financial crisis of 08-09. The S&P 500, for example, has summarily trounced on the international stock market. And that was a comment in this person's question was, it's been a drag on my performance, my portfolio returns. And it has. I can't dispute that. I mean, there may have been pockets here and there where international did better over the last 15 years. But by and large, since 08, 09, no, US has been on an absolute tear. But prior to that, from sort of the 2000, when the tech bubble burst, to the financial crisis, when the US really started its historic bull market, international stocks did better than US stocks because US took more of the brunt of the tech bubble bursting and the mortgage crisis and the fallout related to it of 08, 09 compared to international stocks. So international stocks fared better over roughly that decade. Now, that's no guarantee, with any investment discussion, past performance is no guarantee of future results. That's the same. No one can say international will eventually have its day where the rest of the world collectively does better than the US stock market, but maybe it will. There's a case to be made. US stocks now, by most metrics, are really expensive, overvalued, if you will, compared to international stocks. So that right there is food for thought in thinking that international stocks going forward could potentially be poised to do better relative to US stocks. But again, no guarantees, so nobody knows. So should you have international stocks? Again, do with this as you please. There's a really good chance that if you don't have international stocks and you just continue to invest in the US, that might very well do better than if you had some international stocks. But it's completely defensible, completely prudent in the name of good, true, meaningful diversification. Yes, I think having international stocks is very valid. It has lagged for a while, but there is good reason to think, or at least defensible reason to think, in the name of prudent diversification, that true international diversity is wise, is good to have compared to just US and its indirect international exposure. The next sort of comment or question would be, well, how much is the right amount international? Like, good luck figuring that out. Now, for what it's worth, if you look at like model portfolios or target date retirement funds, of the stock exposure, some big firms, investment firms, will use up to like 40% of the stock exposure international. Some people are like, what are you doing? Well, if you look globally, if you look at the market capitalization or size of the stock market of each country globally, sure enough, US is about 60%. The rest of the world collectively is about 40% of the total global stock market size. So if you just simply want to be invested sort of how the global stock market is represented, yeah, that's 40% international stock exposure, right? Now, you may feel that's too heavy, in which case, so be it. You're completely free to invest as you choose. But maybe you don't do 40. But my point is, don't be surprised if you see some portfolios having 40% of their stock exposure in international, because that's just simply mimicking the world as a whole. So that makes sense on the surface. In reality, maybe most people, at least in the US, investors don't want that much international exposure. So maybe they do a third of their stock exposure international, or maybe as low as like a fifth or 20%. You start getting much below that. If you only have like 10% international stock exposure, it's like, what are you really doing? That's not really enough to move the needle. I don't want to say don't bother, but it's like you're not really diversifying much. I mean, I guess some is better than nothing if you're trying to be diversified, but I don't know. Long way of saying there is no like definitive, objectively right percentage of your stock portfolio that should be international. But hopefully my thoughts and comments now at least give you food for thought for, it's not necessarily bad to have actual international stocks. It's a good thing in theory, in prudent investing fundamentals, to have international exposure. But yes, it has been comparatively a drag versus just US portfolio over the last 15 years. One more comment on that, though. I've talked about this before and written about it. The majority of the US stock market's return have been really skewed from a handful of major, large behemoth tech companies: Microsoft, Apple, Amazon, recently NVIDIA, Tesla, Google, Facebook, Netflix was in there for a while. Go back, look at the composition of the S&P 500. Like, I forget the exact statistic, about a third of it is accounted for by the top 6 companies. And their returns have been gangbusters this year and most of the last 15 years. You dig down and look at the other 490-ish companies in the S&P, their returns have been kind of blah, frankly, over the last 15 years. Not bad, but it's really those large behemoth companies. They've been dragging the whole index upward and really sort of skewing it. Now, it is what it is. I'm not saying the S&P is wrong. Its returns are what they are, and they've been great. But just know that it's like the S&P 500 exposure and bet on that is really just a bet on the large behemoth US tech companies because they dominate the index. So anyway, all right, that's that. Thank you for all the questions. This last one about international was good. I hope you enjoyed it.